Hey everyone, it's Gold Trader Neo. Today, we're diving deep into a trade I executed during the New York session on a Wednesday, starting with a modest 100,000 yen. We aim for a 10 million yen profit within a week. This particular trade ran from 2,093,353 yen to 3,421,632 yen before I closed it. I encourage you to open TradingView and compare my charts to yours. To keep things concise, I've sped up the video to 16x. Feel free to pause or rewind at any point. I've also edited out less significant price movements post-entry to save time. As always, I'm assuming my viewers have a solid grasp of technical analysis and are already consistently profitable traders. So, I'll keep explanations of entry and exit points brief. Instead, we'll focus on the interplay between brain management and finance management. Specifically, we'll delve into the relationship between position size and cognitive load. This is a topic extensively explored in behavioral economics, particularly through prospect theory. We'll connect the dots between this theory, the sigmoid function, and our recent trade. Let's explore how our psychological responses to gains and losses can influence our trading decisions and ultimately our profitability. Let's quickly address the market context. We're currently in a ranging market on monthly and weekly time frames. This is essentially a period of energy accumulation. What traders worldwide are watching closely is how long this period will last. Despite numerous economic indicators being released during the New York session, they've all resulted in temporary, short-term noise, failing to trigger any significant moves. Right now, traders are likely employing MTF analysis to measure the time taken for each time frame to digest a market. They're probably taking small profits at points where distortions occur. The rectangles on the chart represent the time taken for price to consolidate horizontally. The vertical dimension, on the other hand, is adjusted based on the NBE theory, signifying the price range. Now, let's get to the main topic, the correlation between brain management and position sizing. Regarding position sizing, for a 2 million yen account, I would typically allocate a maximum of 40 lots. I'll then adjust this based on the market conditions, dividing it into halves, quarters, eighths, or sixteenths for risk management. Let's say we divide our position into 4 equal parts. In this case, we're estimating our maximum potential loss to be around half of our account balance, which is 1 million yen. Our daily target is to double our account balance. Unfortunately, due to a mistake in our exit strategy, we couldn't achieve that this time. Now, regarding divided entries, we'll naturally adjust our position size according to changes in market conditions. If we lose, we accept the loss commensurate with our position size and start over. If the market moves as we predicted, we'll employ pyramiding or the Parley method. Even if the market moves against us, we'll use the martingale system as long as our underlying rationale remains sound. When we have an opportunity to secure profits, we must maximize them. As a general rule, we'll close all positions and reset our minds. This is to clear our minds of unnecessary information. As our account balance grows, the cognitive load on our brains increases. Even though the theory remains the same, our minds may struggle to keep up. This has already been mathematically proven by the sigmoid function graph. If you'd like to verify this, I've created a detailed video explaining the prospect theory, the function graph of mental load for profits and losses, and specific experimental data, including the number of experiments and results. Most FX schools and salons advise their students to trade with a minimum lot size to avoid mental stress when teaching position sizing. This is because emotional control becomes increasingly difficult as position size increases exponentially. Since beginners don't have an objective understanding of the essence of prospect theory, they may sometimes blow up their accounts with reckless position sizes. Moreover, they prioritize emotional interpretation over a calm observation of facts, making it difficult to understand the underlying causes. Furthermore, instructors often have only a superficial understanding of prospect theory and cannot articulate it to their students. As a result, most traders get stuck in a vicious cycle of failure. Over 70 experiments on losses and gains have been conducted worldwide, and the results have led to a Nobel Prize in economics, so we can confidently accept the credibility of prospect theory. As a side note, there's a real-world example of such incredibly foolish behavior. The Japanese Ministry of Finance and the Bank of Japan. They have been damaging the Japanese economy for over 30 years by implementing monetary policies that completely defy the common sense of macroeconomics. Despite this, they are still pushing ahead with tax hikes instead of reflecting on their mistakes. Even though former Fed Chairman Ben Bernanke came to Japan to lecture on the errors of their economic policy, they still refuse to change course. The Bank of Japan, which is raising real interest rates in a deflationary environment where the output gap is not tight, is considered a foolish policymaker by economists worldwide. Moreover, comparing Japan's economic growth rate to other advanced countries clearly demonstrates that it was a wrong policy. Despite the obvious results, they still refuse to change course, which is simply inexcusable. This suggests that there are many people with borderline intelligence who cannot distinguish between facts and interpretations. That's why there will always be people who provide fodder for the market, and as winning traders, we should simply be grateful for that. Now, back to the main topic. The way we control changes in position size can significantly impact our profits. Ideally, if the market moves as we predicted, we should maximize our profits. This is because opportunities are limited, and the more trades we make, the more brain fatigue we experience, leading to mistakes. Therefore, we must focus on maximizing profits in those crucial opportunities. There are videos out there showing people bragging about making 500 or 600 pips on gold, but these are completely meaningless without discussing position size. Additionally, if they don't include calculations of the trading period and the return on investment relative to the account balance, it's still meaningless. For example, if you earn 10 million yen with a 100 million yen account over a year, your annualized return is only 10%, which defeats the purpose of taking on the high risks of FX trading. It's a waste of time to listen to discussions that lack these fundamental prerequisites. For instance, targets are set without clear deadlines. This shows a complete lack of basic strategic literacy, rendering the discussion meaningless. Discussions about pips without specifying position sizes, and talks about profit without considering capital turnover or return on investment over a period are all pointless. These are discussions aimed at the financially illiterate, and we need to be mindful of that. Now, let's talk about the brain load in this context. Increasing your capital from 100,000 yen to 1 million yen and then to 10 million yen can be considered a 25-fold increase in trading-related brain load. From my personal experience, I can tell you that I found it increasingly difficult to take profits at the optimal time. If you watch this trading video carefully, you'll see that the maximum potential profit based on unrealized gains was actually 4.8 million yen. In the middle of the night in New York, with market conditions that didn't quite align with the NBE theory, I ended up missing out on a significant profit. As you can see, with the 1-minute chart showing a downward trend, many traders would prioritize taking profits over their logic. This was only natural, given that the logical scenario wasn't working as expected. In other words, that was a judgment error. This is a common problem for many traders. During a trade, our vision tends to narrow, leading to careless mistakes. However, once the trade is over, the brain burden disappears. Our vision returns to normal, and we can think clearly again. As a result, we can easily identify the cause of our mistakes. But it's too late once the trade is over. If the mistake is severe enough, it can lead to self-loathing. Ultimately, I only managed to secure a profit of around 400,000 yen, missing out on a potential 1 million yen. One of the reasons for this was that the previous chart showed a 5-minute candlestick that extended beyond the last push, leading me to mistakenly believe that the NBE theory would work this time. As you can see, when making trading decisions, we need to process information from various sources including MAs, lines, and time. With a 25-fold increase in brain load, it's easy to make such judgment errors. I'd love to hear your thoughts, strategies, and approaches in the comments below. Now, while it's relatively easy to turn 100,000 yen into 1 million yen, why is it 25 times harder to turn 1 million yen into 10 million yen, given the 25-fold increase in brain load? This is related to the learning curve. As I've explained in previous videos, growth and stagnation phases alternate. During the stagnation phase, neurons in the cerebellum are still in the process of formation due to incomplete information processing in the brain. Additionally, the number of synapses connecting these neurons is insufficient, which means that automation and multitasking are not functioning effectively. This is what we mean by a learning plateau. To overcome this, the only way is to repeatedly train to create new neurons and synapses in the cerebellum. The good news is that even if you're not very intelligent, you can eventually achieve this. Even if you don't understand the theory, you can hone your skills through repeated practice. If you focus on this, even a fool can eventually succeed. Even if you can't achieve a 10-fold increase in your funds within a week and have to settle for a 5-fold or 3-fold increase due to your limitations, you can still make a living from FX trading. This largely depends on your individual perspective on money and life. So I think it's best to approach it positively. I'd appreciate it if you could share your thoughts and comments on this topic. It will motivate me to create more videos. Next time, I'll be discussing the mechanism and utilization of goal achievement motivation related to the Big 5 personality traits. To succeed as a forex trader, a variety of skills and personality traits are required. From the perspective of the Big 5 personality traits, the following elements are considered particularly important: openness, interest in new information. The forex market is constantly fluctuating and new information is frequently disseminated. To flexibly respond to changes in new trading strategies and economic indicators, a strong desire to learn and the ability to gather information are essential. Creativity. The ability to develop unique trading methods without being bound by existing strategies is a powerful weapon for survival in a highly competitive market. Conscientiousness. Self-discipline. A high level of self-discipline is required to execute planned trades and avoid emotional trading. Sense of responsibility. Even in the event of a loss, it is important to calmly analyze the situation and take corrective measures. Neuroticism. Lower is preferable. Stress tolerance. The forex market is constantly fluctuating and full of unpredictable factors. Even when experiencing significant losses, it is important to maintain composure and make sound judgments. Emotional control. It is necessary to analyze the market from an objective standpoint without being swayed by fear or greed. Extroversion, to some extent, is necessary. Communication skills. Communication with other traders and analysts is essential for gathering information and executing trades. Proactiveness. The ability to proactively seek out new trading opportunities and take action is required. Agreeableness. Depending on the situation. Teamwork. It is possible to generate greater profits by cooperating with other traders. Flexibility. It is also important to listen to the opinions of other traders and be able to flexibly modify one's own ideas. However, these elements are merely general tendencies and do not necessarily apply to all traders. For example, there are traders who have succeeded through meticulous analysis and self-discipline, even with a highly introverted personality. So, goodbye.
Thank you for watching until the end. If you found this video helpful, please like and subscribe. Also, I'm available to answer any questions you may have about gold trading on Discord. Additionally, I offer free Google Meet consultations every Sunday from 6 p.m. to 8 p.m. where you can ask questions about trading or discuss your concerns. Feel free to utilize this opportunity to improve your gold trading, not only in terms of technical analysis, but also brain and finance management. You can find the link to the Discord in the description. I look forward to seeing you all again in the next video. Please don't hesitate to join us.